So I'm very excited to be able to present to you leverage and rate of return heterogeneity among US households. And this is a reproduction of the presentation given at the Eastern Economic Association. So in this paper, I'm going to be documenting how and why returns on wealth permanently differ between US households and how returns on wealth vary over the wealth distribution. So I'm going to be doing this by proposing measures of returns that in panel data for households in the United States. Okay, so we have panel data on household level returns. I'm going to be estimating permanent heterogeneity across households by using fixed effects with empirical Bayes shrinkage. I'm going to be documenting how returns vary over the wealth distribution and why. And then I'm going to examine potential correlations between the permanent differences in returns and wages across US households. So actually the motivation for this paper came from, I was writing down a quantitative model with heterogeneous households, and I wanted to include both labor income inequality and return heterogeneity. And there just was, for me, there wasn't enough evidence to pin down this very strong assumptions I was making in the model that was going to basically lead to what my three conclusions were. And one of the reasons for this is that data on returns are actually very hard to find. In fact, there's no panel data on returns on assets or wealth for the United States. And so we don't observe the household level covariance matrix, for example. And so a lot of the evidence that people have used is from aggregate indices like stock markets or housing aggregates. But this, as we'll see, is not very good. And one we're really interested, a lot of quantitative models have included labor income inequality. And there's a very large literature looking at the importance of that for explaining wealth inequality, as well as estimating the exogenous processes and endogenizing certain aspects of why labor income is unequal across households. But we also know that if returns, one other aspect of heterogeneity between households could be the return on assets. And if returns do differ across households, then we know theoretically that could be important for explaining certain aspects of the wealth distribution, including its fat tail and social mobility. And quantitative models have tried to tease out the importance of this channel in explaining certain aspects of the wealth distribution and social mobility, and finding it's important conditional on the assumptions that they're making. But really the empirical evidence, the test of those assumptions is just really starting to begin to be empirically validated. In the most related paper to this is the Fajring and other papers, and Bach and others. They look at Scandinavian countries. Fajring documents permanent heterogeneity in rates of return on assets. Okay, and this paper difference is very similar to that, but it differs in the sense that we're looking at the US and we're interested in permanent heterogeneity and returns on wealth, which is what matters for wealth inequality. And but the PSID in the United States has been used to measure returns for specific asset classes, including private equity and for housing. And what I'm going to be building upon a lot of those studies and putting together a measure of total rates of return for the household. So the model I'm going to be using to document permanent heterogeneity across households is I'm going to be regressing the rate of return on wealth for household I at time t on year and age indicators, because I have unbalanced panel data and because I'm interested in a measure of heterogeneity that is invariant over the household's age. So the residual is then regressed on a set of observable household characteristics, the same that would be used for studies of labor income inequality, but then I'm also including portfolio shares interact with time fixed effects, as well as an indicator if that asset was sold in that period. The residual, the unexplained component, is the sum of the permanent heterogeneity as well as the idiosyncratic transitory heterogeneity. And I have a whole separate paper looking at this transitory idiosyncratic risk and how it relates to this permanent heterogeneity. So what we're interested in this paper, though, is this epsilon I, this permanent heterogeneity in rates of return across households. And I'm going to be identifying that by using fixed effects with empirical Bayes shrinkage. Okay, so the nice thing about this is that the estimates are consistent and unbiased and are very robust to idiosyncratic measure and transitory measurement error. So the key parameter we're interested is the variance of this epsilon I, and we're going to be doing the same analysis for the rate of return on assets. And then so we have the standard deviation for the rate of return on wealth and assets. And so we can get a measure of how much they differ and how much of this difference is driven by the degree of borrowing and the cost of borrowing, which defines the difference between rate of return on assets and wealth. And then we're also going to look at a summary statistic, which is the permanent component share of the variance, which is actually a sufficient statistic for pinning down optimal taxation. So we're using the panel study of income dynamics. We have 20 years of panel data. This is the revised panel study of income dynamics. And since the revision, they've included in every wave, we observe asset values and net investment, as well as the debt, the degree of debt. So we can calculate wealth and we can calculate returns that are net of investment. And so for the return to total household assets, in the numerator, this is all asset incomes, which includes flow dividends from each asset class J, as well as capital gains that are net investment. And one of the advantages of the PSID is that for our asset classes, we observe net investment for every asset class. And so particularly important for housing, because we can see by calculating our return in this way, we know that when the housing value is appreciating, that this is coming from capital gains and not just because someone made a major upgrade to their housing. Similarly, we observe asset values in every period, and because we observe net investment, we don't have to average in the denominator. This differs from the rate of return on wealth because in the denominator, it is assets minus debt, right? So net worth is if you sold all your assets and paid off all your debt, how much would you have left? And so also in the numerator, we have to account for the cost of borrowing, which is net of tax. Okay, so every database or all these measures of returns are going to have their different comparative advantages. One of the and the PSID and the measures that are proposing in this study does have its advantages. One is that it's US data. So many of the quantitative models are calibrated to the United States. And so we want to be able to have US evidence. I've talked about it, but asset values are net investment. So this has a number of advantages. And for housing, we don't have to rely on hedonic pricing measures, which could understate the degree of heterogeneity. And then we also have encompassing measures. So it includes everything that the household owns. And some things in the Scandinavian databases are not like pensions, and then different types of secondary housing and non-taxable assets. And together in the United States, at least, this represents about 20% of the total household wealth portfolio. So definitely there's aspects of the data and of the US portfolios that are going to be different than the Scandinavian databases. And then the returns can be disaggregated by asset class. So we observe rate of returns on housing and secondary housing, private businesses, public equity, and risk-free assets. And in the revised PSID, there's no top coding. So no observation is top coded or truncated at a high value. Of course, the panel study of income dynamics is a representative survey, but it's not for the full population. It's survey data. While this has advantages on the reporting of housing, for example, we don't observe individual asset holdings that are being reported to an authority. There are a number of advantages in the PSID, especially beyond public equity, that I think is incredibly important. It could be incredibly important. So this is the summary statistics for the data. So for the sample that where I require a measure of both rate of return on assets and wealth to be observed for each household, we observed about over 3,000 households on average for about 6 consecutive waves. And the average real return on total household assets is 3.5 percentage points. There's some standard heterogeneity, some standard deviation around this estimate. And in fact, for all of returns of assets and wealth, we find that the standard deviation within households is actually larger than the standard deviation between households for this heterogeneity. We also, however, when we look at the average return to total household wealth, this is substantially larger, all right, or twice as large as the average return on household assets, and suggesting that there is an important role for the degree of leverage and the cost of borrowing in explaining heterogeneity across households in their returns on their wealth. And we also find different permanent heterogeneity within each asset class. And our measure of total leverage is our debt to asset ratio is estimated to be 40 percentage points across households. So households hold about 40% of their debt relative to their assets. Okay, so this is one of the main findings. This table summarizes one of the main findings of the paper. So what we're documenting here is the a standard deviation of our epsilon, the permanent heterogeneity in returns for returns on assets and returns on wealth. And what we find here is permanent heterogeneity and rates of return on assets. In the United States, it's highly significant, and it's actually pretty close to the measure documented in Norway. However, there is also permanent heterogeneity in the rate of return on wealth, and it is over twice as large. Okay, so the majority of the permanent heterogeneity in rates of return on wealth are actually driven by the degree and cost of borrowing between households. And this suggests that the heterogeneity, if we, for example, calibrate our quantitative model to the heterogeneity documented for the return on assets, and assume that it would be the same for the rate of return on wealth, we would be understating the degree of heterogeneity in rates of return on wealth. We also find permanent heterogeneity within each asset class. And of course, the importance of borrowing tends to be more important for primary housing and secondary housing, less so for businesses, but still represents about 30%. Turns out these estimates are actually incredibly robust in terms of the minimum number of waves we observe them for, whether we, and one of the reasons, and all the sort of data assumptions, and one of the reasons is because the empirical base shrinkage is robust to transitory idiosyncratic returns and to measurement error, transitory measurement error. The standard deviation is a little larger if we count married households twice, which is what was done in Fazering, as well as if we don't require a measure of rate of return on wealth. So we just look at the rate of return on assets, conditional on the minimum asset holdings. And then our estimate actually becomes even closer to the Fajring, another measure. And the one thing that we are quite interested in is, is it just entrepreneurs that drive this permanent heterogeneity? And one of the things we can do is exclude the sample of households that are private business owners. And even excluding households that own private equity, we still find permanent heterogeneity in returns. Okay, so I think what this is suggesting is that it is not just entrepreneurial activity that is driving this permanent heterogeneity. Similarly, if we exclude households that own public equity, we still find permanent heterogeneity. So even if they don't participate in the stock market, but if we exclude households that are not homeowners, we no longer find significant permanent heterogeneity across households in the rate of return on assets. And now, of course, if you're a homeowner, you're more likely to own private equity and participate in the stock market. So this is not just a housing story, but it definitely does suggest that home ownership has an important role to play. So we've just looked at the rate of return, permanent heterogeneity and rates of return on assets and wealth. And so we want to look at the same for leverage. We know that leverage is important, but how much of this leverage is permanent across households? And in fact, we find that there is permanent heterogeneity in leverage. It's quite large for housing and is driving a large share of the permanent heterogeneity in the rate of return on wealth. So one thing we also want to test is if the permanent heterogeneity in the rate of return on assets between households is being driven by portfolio characteristics, right? So portfolio shares and measures of relative volatility or market betas, it turns out doesn't make that much of a difference. But I'm using relative volatility because it's hard to pin down a benchmark beta, for other household assets like collectibles. So one thing we find is that when we include portfolio shares or risk, the degree of risk taking within each asset class into the first stage of the regression, and so removing all of its explanatory power and that of its covariates, we find that we still find permanent heterogeneity across households. So it is not just portfolio characteristics and risk taking that's explaining it. And this is not necessarily surprising considering that we've also found permanent heterogeneity within each asset class. Okay, so everything thus far has been about type dependence, so how returns vary across households. And now we want to turn to scale dependence, which is how returns vary on average over the wealth distribution. And so we're just going to be regressing our measures of returns on the initial wealth ventile. And one of the things that we see here is that for the rate of return on total household wealth, it increases, right? So households have positive wealth, above 15% or above the 15th percentile of wealth. Then it increases as households start participating in housing and public equity, and then actually declines thereafter. So this is a bit surprising because when we look at this is a look at the rate of return on total household wealth, whereas excess returns on assets have been documented to be increasing for the wealthiest households. And a lot of this comes down to the fact that as households become wealthier, they're systematically paying down their debt for certain asset classes, in particular for primary housing. And we can see here that the rate of return on wealth to primary housing is actually declining as households become wealthier, primarily because they're reducing their leverage. And we can see this when we look at leverage over the wealth distribution, which systematically declines for total leverage as well as for primary housing leverage. And this dominates actually the increase in leverage that we're observing for private business owners, right? And one of the reasons why private business leverage may be increasing is because maybe wealthier households own more capital intensive businesses that require more borrowing, or it's to offset the declining returns to scale on average that we're observing for private businesses. In fact, we find decreasing returns to scale in housing and private businesses. Rates of return on financial assets are increasing, but most of this is actually driven by risk-taking and moving risk-free assets from checking and savings accounts into bonds, risk-free bonds. And then we actually find that on average, we have declining, and then increasing, then declining returns on total household assets in the United States. However, all the scale dependence is on average. We also want to look at how this permanent heterogeneity differs over the wealth distribution. And so one of the things that I find is that when we look at this permanent heterogeneity, households that are wealthier have higher permanent returns relative to the less wealthy households. In fact, there's a very strong, very linear correlation which suggests this permanent return differences across households, and particularly for leverage, can be explaining a large share of this permanent heterogeneity. And you would expect this to rise endogenously in a model, if returns are important for explaining wealth inequality. So we're also want to go one step further and try to understand what could be driving these differences in returns on assets and leverage across households. And so we're just going to look at a simple Panner regressions. And one of the things we find is that while portfolio shares are important for explaining returns to total household assets, it's actually a primary housing share that's positively associated with higher returns on average. In addition, there are permanent household characteristics, including education and race, that are important for explaining heterogeneity in returns. Even when we include, of course, risk is quite important, and also relative earnings. And you can think about this as, if housing is important for explaining returns, buying a house and getting a mortgage on a house is conditional on having labor earnings and a reliable source of labor income. So we can look at this by asset class, so rate of returns by asset class, and a couple of things here. So education ends up being important primarily for housing and for risk-free assets. Similarly, race turns out just to be important for the risk-free assets. Portfolio shares matter, and actually say that as a household specializes in terms of their portfolio shares, they get declining returns to specialization, which suggests, which has some important implications for tax policy, I think. Similarly, permanent characteristics of the households and portfolio characteristics are important for explaining the degree of leverage, being an advanced degree holder, having high earnings are all important for explaining leverage, as well as marital status and marital status primarily. Okay, so what's interesting about that is that we have these permanent characteristics of the household that are associated with this differences in this the degree of rates of return on assets, and things like education are also going to would be explanatory power for labor income inequality. So we want to ask, is there a correlation between the permanent heterogeneity in returns that we're observing and the persistent component of labor earnings, or the explained component of labor earnings? And the answer is yes. So there's about a 50% correlation between the permanent returns and the persistent component of labor earnings, being actually quite high for private businesses. And I guess this isn't entirely surprising, again, because education tends out to be important for explaining both uh, returns and labor earnings. So to summarize, this paper has documented permanent heterogeneity in returns across US households. Moreover, I find that this is the first estimate of the permanent heterogeneity in rates of return on wealth, which is actually twice as large as previous estimates that have looked at the rate of return on assets. And it's the rate of return on wealth that matters. So in some ways, people have been underestimating the degree of heterogeneity in rates of return. I find that housing and the regressivity of after-tax mortgage rates are important for explaining household-specific returns. I go into this in detail on more paper, but as households become wealthier, the cost of borrowing declines. It's actually turns out to be somewhat important for explaining scale dependence that is not related to the degree of risk taking. We found that we have declining returns to wealth as households become wealthier, as well as decreasing returns to scale and specialization in assets. And then we've also documented correlated heterogeneity in labor earnings and returns across households. So the empirical observations in this paper, I think, are quite interesting, important. They provide evidence for the United States. They they can be used to test the assumptions that have been made in previous papers and provide a roadmap going forward into the assumptions that and facts of the data that we would like to replicate in future studies, looking at the importance of return heterogeneity to explain wealth inequality. So thank you very much for your time. Let me know if you have any questions or comments.